$850 billion. Let that number sink in for a moment. This isn't some abstract figure buried in a government report that only economists care about. This is a financial weapon of mass destruction, and right now, the safety is off. The finger hovering over the trigger belongs to the Chinese government, and what they're doing with American debt is about to change everything you thought you knew about financial security. For years, the so-called experts told us this day would never come. They laughed at anyone who suggested the bond market could actually collapse. They called it fear-mongering. They dismissed it as conspiracy theory nonsense peddled by doomers wearing tinfoil hats. But here we are, watching the impossible become inevitable in real time. The largest holder of American debt outside our own government is actively dismantling their position, and the ripple effects are going to reach into your wallet, your mortgage payment, and your retirement account, whether you're paying attention or not. This is not just another market cycle. This is not some temporary blip that will correct itself by next quarter. What we're witnessing is the financial equivalent of a divorce between the world's two largest economic superpowers. And like any nasty divorce, the assets are being divided and the lawyers are circling. Except in this case, you're not just a bystander watching from the sidelines. You're collateral damage. Every single asset you own, from your home to your stock portfolio to the cash sitting in your bank account, is about to go through a repricing event that most people are completely unprepared for. The 30-year mortgage rate, that foundational pillar of the American dream, is about to detach from anything resembling normalcy. We're looking at rates that will make the 7% we saw recently look like the good old days. And here's the kicker. The Federal Reserve, that all-powerful institution we're told controls the economy, is about to discover they're not as powerful as they thought. When the biggest creditor on the planet decides to walk away from the table, all the fancy economic models and all the emergency meetings in Washington won't matter one bit. If you thought buying a house was expensive before, you haven't seen anything yet. If you thought refinancing was out of reach at current rates, buckle up. What's coming next is going to redefine what affordable means in America, and not in a good way. Now, to really understand why this matters, why this isn't just another scary headline that will blow over, you need to look past the surface level. Most financial analysts are focused on one specific number. They're tracking Chinese holdings of standard United States Treasury securities, and that number sits around $760 billion. That's already an enormous position. But that's not the complete picture, not even close. When you include agency debt, the bonds issued by massive government-sponsored entities like Fannie Mae and Freddie Mac, the real number jumps to $850 billion. This is the actual leverage Beijing holds over the American financial system. This is their nuclear option, their economic trump card, and they're starting to play it. For more than 2 decades, we had an arrangement. Call it a deal, call it a symbiotic relationship, call it whatever you want. The mechanics were simple and brutally effective. China manufactured goods, everything from smartphones to sneakers to furniture. They shipped those goods to America. We bought them eagerly because they were cheap. In exchange, we paid China in dollars. But here's where it gets interesting. China didn't just take those dollars and stuff them under a mattress. They recycled them right back into the American economy by purchasing United States Treasury bonds. This created a perfect closed loop system. China lent us the money to buy their products. It kept American interest rates artificially suppressed because there was always a massive buyer at the Treasury auctions. It kept the Chinese currency cheap, which made their exports even more competitive. And it allowed the average American consumer to live a lifestyle that, frankly, we couldn't actually afford on our own earnings. This arrangement subsidized the entire American standard of living for a generation. But that deal is dead. The trade war that erupted in 2026 broke the cycle completely. It transformed a cooperative partner into a strategic adversary. When the United States government slapped 60% tariffs on Chinese goods, we sent a very clear message. We told Beijing that their dollars were no longer welcome here, that the old rules no longer applied. China responded the only way they could. They stopped recycling dollars into American debt. Instead of buying more bonds, they started selling the ones they already owned. The latest data confirms what many suspected but few wanted to admit. China is liquidating United States assets at the fastest pace we've seen since 2015. This is not some random market fluctuation caused by portfolio rebalancing. This is a calculated strategic decision by a foreign government to weaponize their financial position. They're selling paper promises, these treasury bonds that represent American government debt, and they're using that cash to buy something very different. Gold. Physical, tangible, can't-be-printed gold. For 28 consecutive months, China has been adding to their gold reserves. That's a record-buying streak. They're systematically trading paper issued by a hostile government for hard assets that carry zero counterparty risk. Why? Because they watched very carefully what happened to Russia in 2022. When Russia invaded Ukraine, Western governments froze Russian central bank assets overnight. Hundreds of billions of dollars, just locked up, inaccessible. China learned that lesson. They realized that holding American debt makes them vulnerable to the same treatment, so they're ensuring it can't happen to them. They're building a fortress balance sheet that Washington can't touch. But here's where this goes from interesting to dangerous for you personally. The problem isn't that China is buying gold. Central banks have been doing that for centuries. The real problem, the catastrophic problem, is that nobody is stepping up to buy the bonds that China is selling. The United States government operates on debt. That's not an opinion, that's mathematical fact. We run roughly a $2 trillion annual deficit. That means every single year, the government spends $2 trillion more than it collects in taxes. To keep the lights on, to pay government salaries, to fund everything from Social Security to the military, the Treasury Department has to sell billions of dollars in new bonds every single week. It's like paying off one credit card by opening another one. It only works as long as someone is willing to give you that new card. In the past, China was the guaranteed buyer. They would show up at the bond auctions and purchase a huge chunk of whatever was being offered. Their presence in the market kept rates stable. But now, not only are they absent from the auctions, they're actively dumping their existing holdings onto the secondary market. This creates what's called a supply shock. Imagine if every homeowner on your street decided to sell their house on the exact same day, but there were zero buyers. What happens to home prices? They collapse. The bond market works on the same supply and demand principles. When there are more bonds for sale than there are buyers willing to purchase them, the price of those bonds drops. And here's the critical relationship you need to understand. In the bond market, price and yield move in opposite directions, always. They're on a seesaw. When the price of a bond falls, the interest rate, the yield, automatically rises. This is why we're seeing rates spike, even though inflation has supposedly been cooling. The market understands something that the headlines don't. There is no marginal buyer left. The Federal Reserve is doing quantitative tightening, which is a fancy way of saying they're selling bonds, not buying them. American commercial banks are already stuffed to the gills with government debt. They're sitting on massive unrealized losses, and they can't take on more. Japan, historically a major buyer of Treasuries, is struggling with their own currency crisis, and they're selling United States bonds too. That leaves one buyer of last resort, you, the American retail investor and the American taxpayer. But to convince you to buy a 10-year government bond, to lock up your money for a decade, the Treasury has to make it worth your while. They have to bribe you with a much higher interest rate. This creates what economists call a crowding out effect. Higher yields on government bonds force rates higher across the entire economy. Every loan, every credit card, every auto financing deal gets more expensive. But the most direct and most painful impact hits the housing market. The 30-year fixed mortgage rate tracks the 10-year Treasury yield. It always has. There's a mathematical relationship between the two. If China's selling campaign pushes the 10-year yield to 6%, and we're already approaching that level, mortgage rates have to hit 9%. That's not speculation. That's not a worst-case scenario. That's arithmetic. We are witnessing something absolutely terrifying that hasn't happened in most people's lifetimes. We're watching a complete decoupling. The mortgage rate is divorcing itself from Federal Reserve policy. Think about the implications of that statement. We've been taught our entire lives that the Fed sits in a control room in Washington and steers the economy. They raise rates to cool things down. They lower rates to stimulate growth. That narrative is collapsing. The Fed only controls short-term interest rates, the overnight lending rate between banks. The market controls long-term rates. The bond market, with trillions of dollars of capital and participants from around the world, sets those rates based on supply and demand. The Fed could hold a press conference tomorrow and cut their benchmark rate to zero. They could promise free money. But if China dumps $50 billion worth of bonds that same afternoon, your mortgage rate is going up, not down. This neutralizes the Federal Reserve's most powerful tool. It breaks their ability to rescue the housing market or stimulate the economy through lower borrowing costs. We are entering a new paradigm that economists call fiscal dominance. In plain English, that means the size of the debt pile matters more than the interest rate the central bank sets. When your debt is so massive that the market loses confidence, no amount of rate cuts will save you. Make no mistake, this is economic warfare, but it's not fought with aircraft carriers or missiles or boots on the ground. It's fought with balance sheets and bond auctions and currency flows. The Chinese government knows exactly where America is vulnerable. They've studied us for decades. They know the American middle class is addicted to housing wealth. They know that real estate is the engine that drives consumer spending. They know that 2/3 of American household wealth is tied up in home equity. By forcing interest rates to stay elevated, by creating persistent upward pressure on borrowing costs, China can engineer a severe recession or even a depression in the United States without ever firing a shot. This is asymmetric warfare at its finest. They're using our own structural weaknesses, our addiction to debt, against us. And the timing is no coincidence. This bond dumping campaign lines up perfectly with the semiconductor sanctions. When the United States cut off China's access to advanced chip technology, when we told them they couldn't buy NVIDIA's best processors, we declared economic war. China is retaliating in the only way that hurts us as much as we hurt them. You cut off our access to chips, we cut off your access to cheap credit. It's a tit-for-tat exchange, an escalation ladder that both sides are climbing. But here's the asymmetry that should concern you. China can survive without high-end gaming graphics cards and cutting-edge artificial intelligence chips for a few years. It will slow their progress, but it won't collapse their economy. The United States economy cannot survive 9% mortgage rates for even a few quarters. It would trigger a cascade of failures that would make 2008 look mild by comparison. Look at what's already happening in commercial real estate. Office towers in major cities are sitting half empty. Remote work killed the demand. These buildings are teetering on the edge of bankruptcy because they can't afford to refinance the loans that are coming due. If foreign selling spikes rates even higher, that's the final nail in the coffin. We're talking about trillions of dollars in real estate value evaporating, pension funds taking massive losses, regional banks that lent to these properties going under. The United States Treasury is effectively powerless to stop this. They're caught in what game theorists call a zugzwang. That's a chess term for a position where any move you make worsens your position, but you have to move. The Treasury has two options, and both of them lead to disaster. Option A, they pressure the Federal Reserve to turn the money printer back on. The Fed buys trillions of dollars worth of bonds to absorb the supply that China is dumping. This props up bond prices and keeps rates from spiking further. But there's a cost. If they flood the system with newly created money, inflation explodes. Your grocery bill doubles. The dollar loses purchasing power. We would essentially be destroying the value of American savings to bail out the bond market and prevent a foreign adversary from winning. Option B, they do nothing. They let the market clear naturally. In that scenario, rates spike, the housing market freezes, businesses can't borrow, consumer spending collapses, and we enter a deflationary depression that makes the 2008 financial crisis look like a minor correction. This is the dilemma Beijing has engineered. Heads they win, tails you lose. Inflation or depression. There is no third option, no clever policy trick that solves both problems. Now, you're probably looking at your own financial situation and asking the obvious question. If holding cash means getting destroyed by inflation and owning real estate means getting crushed by rate spikes, where exactly do I put my money? How do I protect myself? I'm going to walk you through the specific defensive strategy you need in just a moment. But before you can protect your wealth, you need to understand the ghost in the machine, the hidden layer of this crisis that most people don't even know exists. The data shows that China is hiding their tracks. They're not selling bonds directly in a way that shows up clearly in the official reports. They're using intermediaries, custodian banks in Belgium and Luxembourg to mask the true scale of their liquidation. The official number says China holds $760 billion. The real number is almost certainly much lower because they've been offloading debt through these shadow channels for months. Every time the bond market rallies, every time prices bounce and yields dip, China uses that as an opportunity to sell more. They're scaling out of their position methodically. This puts a concrete ceiling on how high bond prices can go, which means it puts a floor under how low rates can fall. The days of 3% mortgages, the days of refinancing your house to take cash out for renovations, those days are gone. They are not coming back for a generation. We are reverting to the historic norm. For 40 years, America had a VIP pass to cheap money. That pass has been revoked. Now we pay full price, and that price is high. You're paying it in higher credit card interest rates. You're paying it in car loans that cost thousands more over the life of the loan. You are paying a geopolitical tax every single month, whether you understand it or not. The American standard of living was built on cheap foreign capital. That capital is disappearing. We are watching 4 decades of globalization unravel in less than 4 years. The bond vigilantes have returned, but this time, they're not hedge fund managers worried about inflation. They're foreign governments selling to inflict maximum economic pain, and that pain is about to spread to corporate America. Major companies borrowed money at record low rates in 2020 and 2021. They issued bonds at 2 and 3% interest. Those bonds are coming due. They have to refinance. Imagine your mortgage payment tripling overnight. That's what's happening to blue chip corporations right now. They borrowed at 3%, and now they have to refinance at 9 or 10%. This will cause bankruptcies. It will trigger mass layoffs. Profit margins will evaporate as interest expenses skyrocket. The stock market is currently ignoring this. Equity investors are betting the Fed will ride to the rescue. But the bond market knows better. The bond market is telling you that the Fed is being held hostage by the sheer volume of debt hitting the system. We are watching a slow-motion train wreck in the deepest plumbing of the financial system. There used to be a safety valve, a shock absorber called the reverse repo facility. This was a giant pool of cash, over $2 trillion at its peak. parked at the Federal Reserve. It acted as a buffer. When the government needed to borrow, it could tap this pool without disrupting the broader market. That pool is now empty, drained. The shock absorbers have been removed from the car. If we hit a bump now, if there's a sudden crisis, the axle snaps. We could see a flash crash in the Treasury market, where yields spike violently in a single session. If that happens, it breaks the derivatives market. Margin calls cascade across the globe. Hedge funds blow up. The whole system, leveraged to the maximum, comes unglued. This is why smart money is moving. Billionaires, family offices, sovereign wealth funds, they're not waiting around to see how this plays out. They see the bond market cracking. They're exiting the blast radius. They're moving capital into assets that can't be printed by a central bank. Gold, farmland, commodities, energy infrastructure, real assets with intrinsic value. For 4 decades, financial advisors gave everyone the same advice. Put 60% in stocks, 40% in bonds, the 60-40 portfolio. It was considered the safest, most balanced approach. That strategy is dead. Bonds used to be the safe part of your portfolio. If stocks crashed, bonds went up and cushioned the blow. That negative correlation was the entire point. But now bonds aren't the cushion, they're the risk. They're the epicenter of the earthquake. The thing that was supposed to protect you is the thing that's going to hurt you. You need to rethink everything. Holding a long-term United States government bond used to be called risk-free. Now it's a bet. You're betting on geopolitical stability, on fiscal responsibility, on world peace. And if you've been watching the news about Taiwan or the South China Sea or the unraveling of global trade, peace is not the trend. The $850 billion liquidation is not a future threat. It's happening right now, this quarter, this month. The dollar is being strangled by the very nations that helped build its dominance. But before I walk you through exactly which 3 asset classes you need to own to survive this, you have to understand the mechanics of how the explosion happens. You need to understand the financial plumbing, because when the plumbing breaks, that's when people panic. Normally, financial plumbing is invisible and boring. Nobody thinks about it until the system backs up and raw sewage floods the house. Then it's the only thing anyone cares about. Right now, a critical valve in the system has run completely dry. It's called the reverse repo facility, and I mentioned it briefly, but you need to understand why it matters. Think of this facility like a giant emergency water tank attached to your house. For the last 2 years, this tank was full. It held over $2 trillion of excess liquidity. It was a shock absorber. When the Treasury needed to borrow money, it could pull from this reserve without disrupting the banking system. It kept rates stable even as the government issued record amounts of debt. But as of right now, that tank is empty. The needle is on E. The $2 trillion has been spent, drained, absorbed. This means the easy money is gone. Every single dollar the government borrows from this point forward has to come directly from the banking system, from your bank's reserves, from money that could otherwise be lent to businesses or consumers. This is the worst possible timing. We're hitting this liquidity cliff at the exact moment China is dumping bonds. It's like driving up a steep hill, running out of gas, and then having your tires slashed simultaneously. That's the United States economy right now. Without that liquidity buffer, banks are scrambling for cash. This puts enormous pressure on regional banks. You remember Silicon Valley Bank? How fast it went from fine to failed in March of 2023? That was just the opening act. What's coming next is the main event. We're watching unrealized losses metastasize across the banking system like a financial cancer. Here's how the disease spreads. Banks take your deposits and they invest them in safe assets, primarily government bonds. But when interest rates rise, the market value of those old bonds falls. It's ironclad math. According to the FDIC, American banks are sitting on over $600 billion in unrealized losses right now. That's $600 billion that's gone, vaporized. But there's a loophole. As long as the banks don't sell those bonds, they don't have to recognize the loss on their financial statements. They can pretend everything is fine. But if depositors get nervous, if you walk up to the ATM and demand your money, the bank has to pay you. To get the cash, they're forced to sell those underwater bonds. When they sell, they lock in the loss. The hole in the balance sheet becomes real. If enough people do this at once, the bank fails. This is exactly what killed Silicon Valley Bank. But the risk is no longer isolated. It's everywhere. And China knows it. By dumping bonds and pushing rates higher, they're making that hole bigger. They're attacking the capital foundation of the American banking system. Beijing understands that banks are the Achilles heel of American power. If the banks can't lend, the economy seizes up. And the Federal Reserve is trapped. They've lost their magic wand. In 2023, they launched an emergency program called the Bank Term Funding Program. It allowed banks to borrow against their underwater bonds at face value, preventing a cascade of failures. But that program has expired. It's gone. This leaves the Fed with 2 choices. Let the banks fail, let the ATMs go dark, let the system collapse, or print trillions of dollars to cover the losses and destroy the dollar through inflation. Both options are catastrophic for regular Americans. But the attack isn't confined to the bond market. It's spreading to the energy sector, and this is the part that should genuinely terrify you. For 50 years, we had an arrangement with the world known as the petrodollar system. If any country wanted to buy oil, no matter where they were, they had to use United States dollars. If Germany wanted oil from Saudi Arabia, Germany first had to obtain dollars. This created permanent structural demand for American currency. It forced every nation to hold dollar reserves. That era is ending. China is now the world's largest oil importer, and they're paying for that oil in yuan. They've set up currency swap lines with Saudi Arabia and Russia. They're cutting side deals that completely bypass the dollar. This reduces global demand for United States currency at the exact moment we need that demand most. For the first time in half a century, Saudi Arabia is openly diversifying away from the dollar. They're accepting payment in other currencies. This shatters what economists call America's exorbitant privilege. We've been able to run massive deficits without consequence because the whole world needed our money to function. That free pass is being revoked. If the world needs fewer dollars to buy energy, they have no reason to hold United States Treasury bonds. This is a pincer movement, a classic military tactic. China is attacking from two sides simultaneously. They're reducing demand for dollars through the petro-yuan, and they're increasing supply of bonds by selling. They're squeezing the dollar to death. The impact is already showing up in the data. Treasury auctions are getting weaker, bid-to-cover ratios are declining. There are failed auctions where the Treasury tries to sell debt and there aren't enough buyers. The primary dealers, the big banks that are required to participate, are being forced to absorb bonds they don't want. They're choking on inventory. Their balance sheets are clogged. This creates a liquidity trap. It's like trying to sell your house, but you can't because the door is nailed shut. You're stuck. In this environment, a sudden shock, a war over Taiwan, a major bank failure, anything unexpected, could cause the entire Treasury market to freeze. And if the Treasury market seizes up, the whole global financial system stops. United States Treasuries are the collateral that underpins everything. If that collateral becomes illiquid, credit markets everywhere shut down. ATMs stop dispensing cash, payment systems fail. The Federal Reserve is terrified of this scenario. They're already talking about slowing down their quantitative tightening. But that's a band-aid on a gunshot wound. It doesn't address the core problem. The core problem is simple. The United States government spends far more than it takes in. We relied on geopolitical rivals to finance that spending. Those rivals have stopped cooperating. So now the spending must be financed through money creation, which is just another word for inflation. This is a stealth tax. You didn't vote for it. It's not on any ballot. But you're paying it. You pay it when gas prices jump. You pay it when your grocery bill climbs. You pay it when car insurance premiums double. Everything gets more expensive to fund government operations. The Chinese government has calculated this perfectly. They're forcing America to choose between two nightmares, hyperinflation or a second Great Depression. They're betting that American politicians are weak, that they'll always choose inflation because it's less painful in the short term, even though it destroys purchasing power over the long term. And if you look at political history, that's an extremely safe bet. So here's what's going to happen. Eventually, probably sooner than most people think, the Federal Reserve will panic, they'll pivot, they'll restart the money printers, they'll give it some sophisticated name like market functioning support or yield curve control. Don't be fooled. It's money printing, plain and simple. This will temporarily stabilize the bond market. Rates might dip for a while, but the cost will be borne by anyone holding dollars. Your savings, your paycheck, your fixed income, all of it loses value. The government will inflate away the debt, and you'll pay the price. Understanding this puts you ahead of 99% of people who are sleepwalking into financial devastation. The question now is, what do you do about it? How do you position yourself to not just survive this, but potentially profit from it? The answer is not complicated, but it requires you to think differently than you've been taught. You need to own assets that benefit from exactly what's happening. When governments print money and debase currency, certain assets thrive. Gold is the obvious one. It's been money for 5,000 years. It can't be printed. It has no counterparty risk. China is buying it. Central banks globally are accumulating it at record pace. That should tell you something. But it's not just gold. You need to own productive, real assets, energy infrastructure, commodity producers, farmland, things that produce real value and can pass on price increases. These assets do well in inflationary environments because their earnings grow with the currency debasement. You also need to be extremely cautious with long-duration bonds. Anything with a maturity beyond 2 years is a gamble right now. If you own bond funds, understand that you're sitting on a potential landmine. The moment rates spike again, those fund values will crater. Cash is also a loser in this environment, but you need some for liquidity. The key is not to hold more than necessary. Keep enough to cover 6 months of expenses and put the rest to work in assets that can preserve purchasing power. Real estate is tricky. If you already own a home with a low fixed rate mortgage, stay put. That's a phenomenal asset. You're borrowing at 3 or 4% while inflation runs much higher. But buying real estate now, at the peak of prices with rates at 7 or 8 or potentially 9%, that's extraordinarily risky. You're catching a falling knife. The most important thing is to understand that the rules have changed. The playbook that worked for the last 40 years, buy stocks, buy bonds, hold forever, that playbook is obsolete. We're in a new era defined by deglobalization, geopolitical conflict, and currency instability. The $850 billion bond dump is not just a headline, it's a regime change. It marks the end of an era where America could borrow endlessly without consequences. The consequences are here. They're showing up in your mortgage rate, your credit card bill, your rent, your insurance premiums. Most people won't connect the dots. They'll blame the Fed or politicians or corporations, but the root cause is geopolitical. We're watching the unraveling of the post-Cold War financial order in real time. The Chinese government is not acting out of spite. They're acting out of strategic self-interest. They're protecting themselves and simultaneously weakening an adversary. And the brutal truth is, it's working. American household wealth is heavily concentrated in real estate. When mortgage rates double, home prices must fall or freeze. Either way, household wealth takes a hit. Consumer spending drops, the economy slows, unemployment rises, tax revenues decline, the deficit gets worse, and the doom loop accelerates. Breaking out of this cycle requires painful choices, massive spending cuts, tax increases, a decade of austerity, but those choices are political suicide. So instead, we'll get money printing, inflation, and a slow erosion of living standards. That's the path of least resistance, and that's the path we're on. Your job is not to fix the system. You can't. Your job is to protect yourself and your family from the consequences. That means educating yourself. It means being willing to make unconventional choices. It means ignoring the financial advice that worked for your parents' generation because the world they invested in no longer exists. The geopolitical landscape has shifted. The financial architecture is crumbling, and the biggest buyer of American debt has turned into a seller. This isn't theory. This isn't speculation. This is data. This is happening. The only question is whether you're going to adapt or get crushed. Every single day, billions of dollars are moving out of United States Treasuries and into hard assets. Every single week, mortgage rates are being repriced higher as the market digests the reality that the marginal buyer is gone. Every single month, the deficit grows and the borrowing needs increase. This is not sustainable. Something has to give. And when it does, when the bond market finally cracks or the Fed finally panics and prints, the reset will be violent and swift. Fortunes will be destroyed, but new fortunes will also be created by the people who saw it coming and positioned accordingly. You now understand the mechanics. You see the trap. You know what China is doing and why. The information advantage is yours. The question is, what are you going to do with it?